Hello and welcome to this week's episode for Spy Trader Now. I am your host. My name is Ken, and our model portfolio is up 2.44% year to date as of April 6th, 2024. We do a three-position portfolio here at Spy Trader Now, and our goal is to beat the returns of the S&P 500 buy and hold investor. Their portfolio is up 9.07% year to date. So we are lagging behind them by 7% approximately. So we've got some catching up to do. But the market is starting to show signs of weakness, and we're positioned for that weakness, and I'll show you that in the presentation. Our stock market strength color signal is green, so we still have a strong market. Here are some past results for the model portfolio. Last week, the S&P 500, and we use the ETF fund SPY, or we'll refer to it as spiders, for all of our charting analysis, and we are referencing the S&P 500. It's just the ETF version of the index. Anyways, the S&P 500 lost 0.89% last week. Here you can see the trend that we were in, and as of the last week, we just came out of that trend. So we're going to see if this is the beginning of something where we come down and correct. And this peak and this peak is where I'm expecting it to come down to when it does make its ultimate correction. And like this correction here, I'm expecting something in the neighborhood of 3 months of a correction, like the summer doldrums. And we'll go through that in the presentation, but basically that's it in a nutshell. Last week, we made no trades in the model portfolio. Here are the trades we've made in 2024. The yellow represents our open trades that we currently have. We have 200 shares of SPY. We're profitable by $6,000, but we also have an in-the-money covered call where we owe $4,600 on that in-the-money covered call. Now, the blessing about an in-the-money covered call is that as time is your friend when you sell a call. So in this case, this covered call is sold. So as time goes by closer to our expiration, 7/19/24, this will become more and more worthless due to time decay. And the only thing that will be valuable is the portion that's in the money. Now, the strike on this is 465, and the market is currently trading at 518. So we're very much in the money on this particular strike price. But that's okay, because we got that cash up front. So we're going to just leave some time here, and we're going to see what this market kind of corrects down to. This is the equity curve for the model portfolio year to date for 2024. This is the equity curve for the S&P 500 buy and hold investor year to date 2024. And here are the two equity curves combined. We always want to compare our model portfolio against the benchmark of the buy and hold investor of the S&P 500. Ultimately, what I really want is our portfolio to be trading above this portfolio, but that has not happened. Market has been too strong, and I've not been positioned to take advantage of that. All right, so here's the Fed Chair Jerome Powell. On May 1st, the Fed held the rates. He did not do anything with the rates. Our next announcement will be June 12th. Is he going to hold, cut, or hike rates? Only time will tell. He's talking about cutting rates 3 times this year, but because of the election, it just doesn't make sense, because his hands are going to be kind of tied, as you would think, between July and November. So if he's going to do something, he'd have to do it next month. But I don't think that the data is supporting his position. We'll see what happens. Now we are looking at things from the presidential election cycle theory. Depending upon the year of the election, historical rates of return for the S&P 500 and this is the NASDAQ 100. President Joe Biden is in the 4th year of his term. Historically, that's a 6.7% gain. Currently, the market is up 3%. 9.70%, which is about 3% higher than where we're at now, giving plenty of room for this market to correct down and still have the historical average. Keep in mind, this takes into account the whole calendar year. Now we are looking at things from the bond market outlook, and the bond market says stay out of the stock market because we have an inverted yield curve, which is bad for equities, and we have rising interest rates, also bad for equity investors. So we are going to keep an eye on this. I'm waiting for this inverted yield curve to normalize, and it has not happened yet. And here is Warren Buffett, the Oracle of Omaha. Here is CNN Business Fear and Greed Index. We've come down. Last week we were at 69. This week we're at 61. We are in greed. So if this correction happens, that'll bring us down into fear, and then we can buy and go more long this market. All right, now we're looking at things from a seasonality outlook. These are monthly bars of the S&P 500. Now, I want to call out this trend line here and this trend line here. And you can see that on this chart, this is the first candle where we came out of this these two trend lines, and we were in those two trend lines for 1, 2, 3, 4, 5, 6 months, so quite a long time. So this could be the beginning of that correction. But going back 20 years, the month of April, there's an 80% probability that we're going to close higher than when we opened the month, and we're currently down 0.89% for the month. So that gives me reason to believe that this month is going to be not really going to go down or up. I see it kind of going sideways, and possibly there's an 80% probability it'll be slightly higher, but I don't see crazy high numbers personally. But I'm not exactly eager to short this market with this data. Now we are looking at a 20-year monthly chart, S&P 500 long-term bull run. Look at this trend line here. We're still above it. Where we broke out, we did a correction, we broke out, and we haven't looked back yet. And the MACD is positive. Now, I knew this was an unsustainable angle of ascent. That's this line right here. And finally, we've reached a peak, and we're starting to come down a little bit. So maybe a little bit of sideways chop, and then get something a little bit more significant where we pull into these moving averages. Now we're looking at a weekly candlestick chart going back 5 years for the S&P 500. Now I called out a rectangle here to show you the last time the MACD topped and started to come down. Now look where the MACD is at now compared to last time. We're way higher. We're above 20 right now, 20.92. You can see that it is clearly peaked and it has topped, and it wants to cross towards its signal line. Now, the last time we actually did that and came down, the market had a 10% correction, and that correction took about 3 months approximately. Now, we are right at the beginning stages of that. If we have another 10% correction, that would take us to approximately 470. Now notice the peak that we have here and the peak that we have here. Well, this peak here comes down to about 465-ish, and then this peak here is about 455. So that is the area that I'm expecting support to be found. So that would be a little more than, that'd be a 10 to 15% correction. Come down, and then that is the area in which I am looking to close out my in-the-money covered call and pick up some long calls. Right now, I guess I could possibly pick up some very long-term puts. I would go out at least a year and a half And maybe I will do that, but in this month of April, I'm not really sure, unless I start seeing some really good softening. But we're right here at this peak here, so it's a great time to possibly be putting on some puts. I'm gonna have to look at that and see if that's something I want to entertain. Now's the time to entertain that. Take advantage of this market correction so that while the market's correcting, we are making money. So that's something I'll take a look at. Now we are looking at a short-term 6-month daily candlestick chart. Now this aqua colored line is that support line from this trend channel that we were in, and we just broke out of it for the past few days. So that's where we stand. You can see the Fibonacci retracements going back to when we started this in November of 2023. And look where the 38 and the 61.8 fall into. It's 450 to 480. Exactly where we want to kind of buy. It would be a wonderful point to pull into. Now we are looking at a risk-on appetite chart, which is a ratio chart of the NASDAQ 100 compared to the S&P 500. And we are at a support line right now, which is not good if I'm going to be putting on a put position, because that would mean that this is going to bounce and start coming up, which means that the NASDAQ 100, the QQQ symbol, is going to start outperforming the S&P 500. And usually when that happens, it's bullish for all equities in general, including the S&P 500. It's just that the NASDAQ 100 will outperform it. Well, if that's the case, not a great time to be putting on a put position. Now we're looking at another ratio chart of the equally weighted compared to the normal cap weighted S&P 500. Now we are down here and moving sideways like we did here and like we did here. This chart is going back 20 years, folks. It's a weekly chart. Now we're starting to move sideways. Once we break out, this is going to be a great time to go long. We're not there yet. We're still in this sideways chop. But look where the S&P 500 is. Now we fell off a cliff here, fell off a cliff here. We have not fallen off of a cliff here. And it's possible that we still may fall off of a cliff. And I do not want to be caught with long calls during that time. So I'm monitoring this to make sure I don't get hosed. Now, it would be wonderful to have some puts on if indeed this was to happen right now. Is that going to happen? I don't know. I don't see that actually happening, but I want to be prepared for it just in case. Okay, now we're looking at the VIX Volatility Fear Index. I have 3 levels in here. I have the ultra low range, the low range where we are currently trading in for the VIX, and then this upper range. This upper range, which is above 20 about, is when you start to really lose money in the S&P 500. The chart is a little skewed because for the past 12 months, we've been trading below 25, which is still fairly low on what the VIX can really do, because the VIX can really jump up there. Now here you can see that trend channel and how the S&P 500 has just broken out of it. And when that happened, the VIX, because it's an inverse relationship, jumped up. So as this jumped down, the VIX is jumping up. Now we are looking at the Thinkorswim platform 5-year weekly candlestick chart with standard deviations, +2, -2 in gold, +1, -1 in pink, regression line in dashed green. Currently we sit at 0.6 standard deviation, which is right here on this candle. Now, see the top that we've reached there? I've got that identified in red, about 480. Then there's a peak here. I've got that identified in green, about 456. So this is the area of support that I'm planning, that I do have somewhat of an expectation for this to correct down into. Then we buy long and go up from there. That's my overall thinking of this market. And we'll see if what I'm talking about actually plays out, but it would not be out of character for it to do that it would take, take 3 months for it to go from its peak to its bottom to when we start to correct out. Now we're looking at the same chart, but going back 1 year. Now here we are at, same thing, 0.6 standard deviation. You can see that from the 0 line to the 1 line. We're approximately here, which is about 0.6. And you can see the red and green lines as well. Now we're looking at the same chart, but this is going back 6 months. And I've put in here the sell zone and the buy zone. So this is where we want it to pull into, buy, and then go long. Now we are looking at a chart that I created here on an Excel spreadsheet where we've got multiple asset classes from equities to precious metals to bonds and also overseas markets, just to determine what's happening. And things are still strong at 92, but they've came down from last week of 96. These are the 11 sectors of the S&P 500. Last week we were at 97. This week we are at 85. Definite softening in this market, but still very strong. Anything above 61 and greater is going to be a green. So obviously at 85 we are a green. Same thing here. Now we are looking at bond yields. Now this is an interesting chart. Wait till you see this. I put down a support level here. Then in this green line, that was a resistance level, and then another resistance level here. Well, we broke above this green line here, hit that the resistance line there, and it bounced and started to come down, hit the support line of the green, bounced, and then jumped up above this resistance line, which is now going to act as support because we're on the opposite side. Now in purple, I drew out what appears to be our new trend channel formation. We are bouncing between the upper and lower channels here, and now we are in this, but this is rising. And look what the S&P 500 did. When we broke above this resistance line, which now is going to act as support, the S&P 500 does not like that. It does not want these 10-year Treasury bond yields to be in this rising market. So, because that's going to make it less enticing for you to be in equities, because you can get better yields or safer returns just by getting some CDs or some type of a fixed investment or something like that. Why would you put your money at risk in the S&P 500? That's why the S&P 500 equities are coming down. So we are going to monitor this and see, but this is a rising trend channel. So if we stay in here, that does not look good for equities. And where we're at now, it's hit the support level. It looks like it's going to continue to go up. So this would support purchasing some puts right now because there's a probability that this is gonna still stay elevated and this is gonna soften up. Okay, I just gave you guys a ton of information in this video. Now comes the critical thinking. What do we do with that information? Well, as of March 4th, 2024, the market summation, according to me, Ken, your friendly host with SPY Trader Now, the market has just started to break down of its long-term uptrend, and it looks like it's due to the 10-year bond yields rising. I feel very strong about this market dropping 10% in the next 12 months. I don't think that's an unreasonable expectation considering where we are and how summer doldrums are ahead of us and not behind us. I will put on the below trade next week. This is outside of some type of an exogenous event, which I don't see happening between me and putting this trade on. But the exact trade that I'm planning on putting on is this one here. It's going to be just one position, one put option, and it's going to be the 470 strike. And that's currently $16.28. So I do have $3,300 in cash. So I could take about half of that, put that to work, buy one call, and if indeed this market does correct, this will become more profitable to me. The market will be losing money, I'll be gaining money, and my chart will be going the other way, which is my whole goal here at Spy Trader Now. So that is what I'm thinking would be good. I would love your comments if you guys think that this would be smart to be putting on at this juncture, or if you guys feel that you would be putting on something else. I'd love to hear your comments about what you think should be happening in this market from your viewpoint. All right, that is going to conclude this video. I hope you got something valuable out of it. If you have not done so already, hit that subscribe button, ring that bell, and do me a solid and smash that like button down for me right now. I thank you, and I wish you good trading.